Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
Imagine a world where money has no country, no bank, no gatekeeper. A system where value moves without permission, borders, or intermediaries. Yet this is not science fiction, nor a distant economic theory. It is already here, silently reshaping how humans define money itself. For centuries, money followed a familiar evolutionary path of trust. First came barter, then metal coins, then paper backed by gold. Eventually, governments removed gold and replaced it with pure confidence. It became valuable because institutions declared it so. This arrangement created stability but also introduced concentrated power. Central banks controlled supply, interest rates, and liquidity cycles. Governments gained the ability to print, expand, and inflate at will. Citizens accepted depreciation as an invisible cost of the system. Over time, cracks began appearing within this centralized financial architecture. Recessions repeated, debt expanded, and crises arrived with unsettling regularity. Each shock demanded more intervention, more stimulus, more monetary expansion. Trust survived, but doubt quietly accumulated beneath the surface. Then came the digital revolution, transforming communication, commerce, and information. Data moved instantly, yet money remained trapped in legacy infrastructures. Transactions required banks, delays, fees, and layers of verification. The internet changed everything except the core mechanics of value exchange. In 2008, during a global financial crisis, a mysterious idea emerged. A white paper described a peer-to-peer electronic cash system without intermediaries. Its creator used a pseudonym, leaving identity permanently unresolved. The proposal challenged centuries of assumptions about monetary authority. Bitcoin introduced a radical concept: digital scarcity without centralized control. Instead of a bank, a distributed network verified and recorded transactions. Mathematical rules governed issuance, eliminating discretionary monetary expansion. Trust shifted from institutions to code, consensus, and cryptography. At first, the idea seemed impractical, even absurd to traditional observers. Digital files were easily copied, making scarcity appear impossible online. Yet blockchain architecture solved this through a shared, immutable ledger. For the first time, digital ownership gained structural credibility. Adoption began quietly among technologists, libertarians, and experimental thinkers. Early transactions carried little monetary value but enormous symbolic weight. A new asset class slowly formed outside conventional regulatory frameworks. Curiosity, skepticism, and ideological conviction fueled its initial growth. As awareness expanded, speculation accelerated, and volatility became unavoidable. Prices surged, collapsed, and surged again in dramatic cycles. Critics called it a bubble, supporters called it monetization. Both perspectives captured fragments of a far more complex reality. Beyond price movements, deeper questions about money itself resurfaced. What defines value when trust no longer depends on governments? Can algorithms replace central banks in regulating monetary supply? Is scarcity engineered by code equivalent to scarcity found in nature? The breaking point came as mainstream finance could no longer ignore crypto. Institutions entered, regulations intensified, and narratives sharply polarized. Some saw liberation from inflationary systems and centralized decision-making. Others warned of instability, speculation, and systemic risk. Meanwhile, thousands of alternative cryptocurrencies rapidly appeared across the landscape. Each promised improvements, efficiency gains, or entirely new economic models. Innovation flourished, but confusion and excess inevitably followed. Markets struggled to distinguish genuine utility from unsustainable hype. Fallout emerged through spectacular collapses, frauds, and failed experiments. Investors learned that decentralization does not eliminate human error. Technology proved resilient, but projects and promises often did not. Volatility revealed both opportunity and unforgiving consequences. Governments and regulators attempted responses, yet solutions remained incomplete. Bans, restrictions, and frameworks produced uneven global outcomes. Some nations embraced innovation, others prioritized monetary sovereignty and control. the tension between decentralization and authority intensified rather than disappeared. Failed fixes highlighted a deeper paradox within modern financial evolution. Centralized systems seek stability. Decentralized systems seek independence and resilience. Both address real weaknesses, yet both introduce new uncertainties. Today, cryptocurrencies exist not merely as assets but as competing ideas. They challenge assumptions about trust, control, inflation, and institutional dependency. Their rise mirrors historical cycles where technology disrupts entrenched structures. Resistance and adoption unfold simultaneously, creating persistent uncertainty. The repeating pattern is difficult to ignore across monetary history. New systems appear during crises of confidence and structural stress. Early chaos eventually gives way to integration, regulation, or replacement. The trajectory remains unpredictable, yet the forces driving it are familiar. Three takeaways emerge from this unfolding transformation of digital money. First, money is ultimately a social technology shaped by collective belief. Second, decentralization redistributes power but does not eliminate risk. Third, volatility is inherent when financial paradigms undergo fundamental change. The warning is subtle but critical for anyone observing this evolution. Innovation can generate progress, speculation, and instability in equal measure. Understanding mechanisms matters more than chasing narratives or momentum. The future of money will reward knowledge, patience, and disciplined thinking.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.